is what we call joint product decisions. And a joint product decision occurs when there are decisions that are required based upon two or more products that are being produced from a common input. Many times in a manufacturing type of process, it's very common to have what we call a joint product, where at some point in time that product can be split off into two separate products and sold separately. When that product is split, we call it the split off point. Okay, when the cost when the product accumulates cost, it is called, prior to the split off point, it is called joint product cost, because that's the cost of all the products it's going to be split off into. Now this example here, I show joint product cost for products A and B. So this is a product that can be split into two separate products, again at the split off point, which would be product A and B. And you can see the representation. We could have a sales price for product A then and a sales price for product B. Now along with this comes another decision that has to be made. When both product A and product B, we can perform further processing to those products and turn them into another product separately, or a derivative of the product, and sell them after they have been transformed into that other product. So in that case, we would be able to sell, instead of selling product A, we would be able to process it further, and it would then sell at a price for product A1. We could also do the same. We could also perform a similar process to product B, where we can again perform a transformation process to product B, and it would become a derivative of product B, or a new product, and we could sell it then at a new price, in this case the selling price of product B1. Now, in order to understand whether or not these particular actions would be desirable, what we need to do is perform an incremental analysis on these joint products. So the first thing we have to understand is that the joint product cost, in other words, the cost that originally were part of the common material before the split off point, are what we call sunk cost. These joint product costs are not relevant in decisions regarding what to do with the product after the split off point. Now let's assume that we have split these two products off between product A and product B. Now the question becomes whether or not we can go ahead and split, or not split, but take product A and process it further and then sell it as product A1. So we have to consider the incremental cost of producing, or the incremental revenue and the incremental cost of producing product A1. Now, if we do that, it is normally more profitable to continue processing a joint product after the split off point if the incremental revenue exceeds the incremental processing cost. So let's see how that works in this illustration. So in this case, we are going to have incremental cost of processing product A into product A1. So what we can do then is we can take the selling price of product A1, here's A1 selling price, from that we subtract the incremental cost of processing product A into product A1, and then from that we subtract the sales price for product A. So we come up with the net incremental profit or expense from transforming product A into product A1. We do the same, or go through the same process with product B. We're going to start off with product B, and then we're going to incur the incremental costs of processing product B into product B1. And the new selling price then will be, there will be a new selling price for product B1. Now what we do is we take product B1, the B1 selling price, minus the incremental cost of further processing product B into product B1, and then we subtract out the sales price of product B, and we come up with the incremental profit or loss from this particular situation, or from this particular example. Now let's go ahead and try a calculation using this analysis. We have a company called Ames Company, and it incurs $100,000 of joint product cost in a common production process to make two products, again product A and product B. Product A can be sold at the split-off point for $70,000. So let's go ahead and take a look at product A. Our sales would be $70,000. I've also included the comment here that the joint product cost of $100,000 are sunk costs, and they're not relevant to this incremental decision process for the joint products. So I'm told that basically at the split-off point, as I mentioned, $70,000 in terms of revenue sales, and we can, if we basically process it further, we can sell it as product A1 for $120,000. So what we can see is, from an incremental revenue point of view, if we compare the sales in product A1 to product A, we're going to have incremental revenues of $50,000. However, we also have to consider the incremental processing costs associated with product A. In this case, those incremental processing costs are $40,000. So if we take a look at the incremental revenue or expense associated with this, we're going to take total sales of $120,000, get our incremental revenue by subtracting out the product A sales of $70,000, so that leaves us with $50,000. Then we have to subtract out the incremental or additional processing cost of $40,000, and we do that, we end up with incremental revenues of $10,000. So this would suggest that we would want to process product A into product A1, because we will be better off by $10,000. Now, in the case of product B, the product B can be sold off at the split-off point for $50,000, and it can be processed further and then sold for $65,000. So in this case, the incremental revenues that we're going to achieve will be $65,000 minus $50,000, so we'll have incremental revenues of $15,000. But we also have to subtract out the incremental cost of processing product B into product B1. And in this case, the additional processing costs for product B are $20,000. So we're going to locate those processing costs to $20,000. Now when we do the calculation, our sales for product B1 would be $60,000 minus our sales for product B, $50,000. That means we would have incremental revenues of $15,000. From that, then we would subtract out the additional processing cost of $20,000. In this case, we would have basically a negative. We would be incurring more in incremental expenses than we would be receiving in incremental revenue. So under this particular scenario, it would make sense in the joint product decision to go ahead and further produce product, to turn it from product A into product A1 and sell it for $120,000. Yet in the case of product B, we would not want to process it further, so we would basically sell product B as is and not worry about basically transforming it into product B1. So let's go on to the last subject matter item that we did not cover, and that is what we call production constraints. Okay, the area that we're going to cover, the subject matter, is called what we call production constraint decision. And we can liken a production constraint decision to let's say the traffic infrastructure within the greater Philadelphia area. Much of the infrastructure was built years ago, and that infrastructure was designed to accommodate a certain number of cars or vehicles, and it was able to process those vehicles fairly efficiently. However, as time went on, and as time goes on, more and more vehicles are occupying that same infrastructure space. So what happens is the infrastructure is no longer capable of efficiently processing those cars down the streets, the highways, or through intersections. And what that does is that causes huge backups of traffic, and it makes for the inefficient flow of traffic. Now, in the case of production constraints, it's kind of similar. A production constraint is anything in the production process that can actually constrain the production capacity of the company. Let's assume that we have a machine that can produce 500 units of a product per day, and all the other machines can produce 1,000 units per day, yet that machine that produces 500 units per day is critical to the production process. In other words, all the units have to go through that machine. At that point, then, we have a production constraint that says that even though everything else, our capacity with all our other machines is 1,000 units, we still can only produce 500 units because of the capacity constraint on that one critical machine. Now, when that occurs, we call that we call that a bottleneck. Bottlenecks occur wherever that bottleneck is, it limits the amount of production in the production process. Now, there is a practice of constraint management, and constraint management is an attempt to simply manage the bottlenecks to either eliminate the bottlenecks or minimize the effect of the bottlenecks. And we're going to list some of those items right now. One item would be working overtime on the bottleneck. In other words, if you have to have a throughput through the bottleneck, you can still work overtime within that bottleneck and produce the additional quantities of units you need to produce simply by typically working overtime. But again, that's typically going to increase your costs. Outsourcing some of the processing that would have been done at the bottleneck. Obviously, if you have a machine that's limited in capacity, you could buy some of those extra products that you're processing through another provider and supplement your production around the bottleneck. Obviously, one of the most obvious solutions is you can invest in additional machines at the bottleneck to basically supplement the bottleneck machine's production. You can shift workers from non-bottleneck processes to the bottleneck if there's some type of labor-intensive work that has to be done. You can also look at, and a lot of companies seek this, is you can look at business process improvements in order to improve the bottleneck, make the bottleneck, create business processes that basically will either they will create an efficiency to eliminate the bottleneck or work around the bottleneck. Also, sometimes one of the problems with the bottleneck is that it ends up producing defective units. So 1,000 units go in, but 800 units come out. So effectively, and the other 200 are in some way defective. So if you could go ahead and reduce the number of defective units, you automatically increase the production of that machine, and that will in effect reduce the bottleneck. Another thing is you can go through what we call a production constraint decision process, and that's what we're going to do on the next slide. And in this case, what we're saying is we have to accept the fact that all the other management efforts to fix the constraint really haven't worked. So we go through what we call the production constraint decision, where we maximize net income by promoting products or accepting orders that provide the highest contribution margin relative to the constraining resource. Now, I know that sounds kind of like, what does that mean? Let's go to the next slide and see how this this production constraint decision process actually works. Now we have a company called Throughput. Throughput manufactures two very popular products, product A and product B. The problem is that both products are manufactured on the same machine, so they're competing for machine time, and therefore we're going to see a potential bottleneck on this machine. Now, the machine that we're talking about can only run for 2,400 minutes a week. So what that tells us, that is going to produce, if we have demand greater than that, or that causes those, if we have demand that causes those minutes to exceed 2,400, that time to exceed 2,400 minutes a week, we're going to end up with a bottleneck. So given this production constraint, what mix basically should Throughput manufacture per week to maximize its net income? So now we have some data that pertains to our two products, product A and product B. We know our selling price per unit of product A is $60 and the selling price of B is $50. The variable cost associated with product A are $36 and product B $35. Now if we take a look at the total demand for the product, there's 2,000 units of product A that are demanded and 2,200 units of product B that are demanded. And in order to make 1 unit of product A, it takes 1 minute on the machine. In order to make product B, it takes a half a minute on the machine. But if we do our calculations, if we want to fulfill all our demand, it's going to take 2,000 units times 1 minute. That's going to be 2,000 minutes. It's also, in order to produce all of product A, it takes a half a minute on product B, so it's going to take 1,100 minutes in order to produce product B. So if I add up the total amount of minutes required to produce product A and product B, that totals 3,100 minutes. But the capacity of our machine is only 2,400 minutes. So we have to make a decision on which product or which combination of products we need to run. And not only that, but which products in that combination will maximize our net income. So we're going to perform a contribution analysis of product A and product B. So let's take a look at product A first. Product A has a selling price of $60 a unit. Its variable cost associated with producing that unit is $36. Therefore, our selling price minus our variable cost equals our contribution margin. Our selling price minus our variable cost equals our contribution margin of $24 per unit. So every time we make a unit of product A, it contributes $24 to covering not only our fixed cost but also our net profit. Now let's compare that to product B. Product B's selling price is $50 a unit. Its variable costs are $35 a unit. So the contribution margin for product B would be the $50 minus the $35, and our contribution margin is $15. Now if we take a look at the contribution margin of product A and product B, it looks pretty obvious that product A has a much higher contribution margin than product B. But since we have a production constraint, we need to understand what the contribution margin is if we restate it in minutes. So step one is compute the contribution margin of each product by its constraint, and the constraint is minutes. So if we take the contribution margin of product A, $24, we divide it by the 1 minute that it takes to make that product. That means when we produce the product, we can earn $24 of contribution margin per minute. Now we take a look at product B. Product B has a contribution margin of $15. It takes a half a minute to produce product B. Therefore, the contribution margin per minute is actually $30 a minute. So product B actually has a higher contribution margin rate per minute than does product A. So step 2 then says compute the number of minutes to produce and meet the demand of the product with the highest contribution margin per unit. And the highest contribution margin per unit is going to be, highest contribution margin per minute. And the highest contribution margin per minute is going to be product B at $30 a minute. So now what I want to do is I want to sell as much of product B as I can, because that has the highest contribution margin compared to our constrained resource. So what I do is I know I have 2,200 unit demand for product B. So there's my 2,200 unit demand for product B. Then I multiply the amount of time it's going to take to produce those 2,200 units, and that's a half a minute per unit. So that means it's going to take 1,100 minutes. Those are going to be the minutes required to produce all of my demand for product B, again with the highest contribution margin. So step number 3 then says compute the number of minutes remaining for the production, in this case of product A, because I want to produce all of product B before I start producing product A, because I get a higher contribution margin per minute for product B. So now I have to determine how many units of product A can I produce, given that I'm using up 1,100 minutes producing product B. So I take the 2,400 minutes machine capacity, which was from this from the explanation up here, 2,400 units of machine capacity minus 1,100 units, which are the minutes that have been utilized for product B, and that means we have 1,300 minutes that are available for producing product A. So step number 4 then is we want to compute the number of units of product A to be produced based upon these minutes remaining, which again is the 1,300 minutes. So we take the 1,300 minutes remaining, we divide it by the 1 minute that it takes to produce a unit of product A, and what that tells us is that we can produce 1,300 units of product A. So the optimal solution, or the solution to maximize our net income in this case, would be produce 2,200 units of product B and 1,300 units of product A. And that ends our presentation. So thank you for your time and have a good day or evening.